What's going on, guys? Welcome back to another video on the before and after series. All about training the eyes, right? So same old thing. We're gonna go through some naked charts first, and then discuss everything, all the price action, and then we'll head over to the marked up version. Okay, so again, the idea of this series is to train the eyes as much as possible, to see liquidity, to see the setups without the markings, without all the drawings on the chart. All right, so without further ado, right into this, we are looking at the pound against the dollar on the 1 minute time frame. Okay, without looking to the left, I just want you guys to focus solely on this current price action. Okay, so what do we have here? To begin with, price is taken out this low, and then ran for the high. Okay, so we'll mark this out here. Took out that high, leaving us a liquidity block. Then from this point, after we traded above this high, price sold off rapidly below this low. Okay, grabbing any liquidity we had resting below this low. Perfect. Now we have a move away. Okay, so what do we got? We got a liquidity block at the low here, and we also have a liquidity block at the high. Now, do we trade from this liquidity block? The answer is no. Since we have taken out this low over here, okay, this now means that any reactions we get from this high are going to be false, okay, and will just be a trap for retail. Okay, so we do not trade from this. We anticipate reactions, okay, from this area, and then we'll look to trade into it after. Okay, so before we ended up trading into this, we'll mark this out here. Okay, as an area of it, like I'll put the X so it tells you guys not to be trading from these kind of areas, again because we've taken out this low. Before we return, or before we traded it back into this high that we printed at around 7 a.m. if you follow my marker here, we left internal liquidity here, we left internal liquidity here, then finally we have our higher time frame liquidity block down here at the low. Okay, so what tends to happen is from this point, okay, price should trade lower. Why? It's because, again, this is a liquidity block, this area. So what tends to happen is we will respect these type of areas, trade away, and once we trade away, now we have money up here. Now we have liquidity above these highs. Okay, so let's get rid of some of this. Perfect. Okay, so the idea is, again, since we're trading at this high, if we do get a rejection and we trade away, this now tells me we got liquidity above this high. Okay, and why is that important? It's important because once we trade away to the downside, this is now a buy target for us because we have liquidity above these highs here now. Okay, and how can we get involved in this? Well, we have internal liquidity here, we have internal liquidity here, finally we have a liquidity block here. The best way to take these kinds of trades is if we do respect the high, again, like this, go lower, maybe respect this low temporarily, like this, and then end up trading lower, taking out the internal liquidity. This ends up being a buy, right? Let's get rid of this one. Oops. Let's get rid of this line here. Move this up. Once we trade below this internal liquidity point, we're now technically trading within this higher time frame liquidity block. So we could take a buy here. Stop loss needs to go below the low. Okay, so buy here, stop loss most likely in and around this area here. Okay, then after we take this buy, look at this, we now have a reason to push up here. We've left seller liquidity at the highs. Okay, so it makes sense for us to take this buy down here. We got an easy entry and a nice and easy target back to the highs here. Okay, and yeah, perfect. So now this is the before. Let's get rid of all of this, all the markups, the markings. I don't know. Can I use there? You know what? Maybe I can even do this. Perfect. So now here's the after. Perfect. So look what ends up happening. We respect this high. Okay, we trade away. So now we have liquidity above here. Look how we come down to this low here, this internal low. We respect it temporarily and move up. Then we sell off further. Down to the low. Perfect. Now we have this internal liquidity point still. And again, what do we have right at the lows? Our liquidity block. Price ends up hunting here, respecting the liquidity block down here. And then we move away. Okay? In coincidence, look what we end up running for. The highs that were purposely left here. Remember, all we did right here was purposely respect the highs to engineer liquidity, move away. Now we have a buy target up here. Buy taken. And there's your target right at the highs. Easy in and out. A to B. Okay? Perfect. So let's head over to the marked up chart now. Perfect. So here's again our reaction from the left hand side after taking out the low. We trade higher. Okay. I am going to sneeze in a second. Apologies. Apologies about that. My allergies are killing me. So again, we get that reaction from the left hand side. We move higher. We trade into the highs, leaving internal liquidity here, here, and then here's that extreme point we end up hunting for later. But look again how retail gets that false reaction to the upside, taking out this high and then selling off further, trading into this internal liquidity point. So technically speaking, is this an invalid buy entry? It's not. The problem is, look how big our stop loss is going to be in our target. So taking an entry after this low is taken out doesn't make too much sense because of the RR. So what I did was I simply waited for this low to get taken out. Okay. With my stop, remember the stop placement is very important here. You want to maintain or keep that stop below that low here, below that liquidity block, because that's what we're taking our entry off of. Okay. So we end up hunting all the way for the extreme, going bullish, temporarily respect the highs here, trap to the downside, and then boom, all the way back up to target all of the liquidity we purposely engineered here. Okay. Another confluence we can look at is time. I put this vertical line on 9 a.m. What do I tell you guys about in between 9 and 10 a.m. is that trap hour. So if I put a vertical line at 9 a.m. and one at 10 a.m., what happens from 9 a.m. to 10 a.m.? We get that trap move to the downside. Okay. And then 10 a.m. opens up, continuation back up. Okay. But yeah, that wraps up this video. I hope you guys enjoyed it. Let me know your thoughts back in the Discord. And yeah, I'll see you guys in the next one.